Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Cameron May. He's there to help facilitate that conversation going on out there in the chat. So be a part of that conversation. Chat in your questions along the way. Cameron's there to help backstop that. And if you're watching in the recorded version, leave us a comment in the comment section. We're glad to have you here with us. We're talking index options today. I'm grateful that Connie Hill was able to fill in for me last week as I was on vacation, but I'm back today. We're going to talk a little bit about our 14 DTE, 7 DTE strategy that we've been talking about for a while. And I want to talk a little bit about hedging activity, because the last time we talked, when I was here, we kind of at the very end put together a quick hedge against adverse movement in the NASDAQ. And today we've got earnings coming from Nvidia. So we're going to talk about that in relationship to this idea of hedging using index options, and why index options are simply one way to manage potential risk in a portfolio. So before we get to that, a couple of quick housekeeping items. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation. It is not advice. So any of the symbols that we look at, those are simply for illustrative and educational purposes only. Remember that investing involves risk, including the loss of principal. Past performance, no guarantee of future results. Now, we're going to be talking equity and index options today. They carry a high level of risk. They're not suitable for all investors. Make sure that you understand the characteristics and risks. Standardize options before considering any option strategy. The options that we will be looking at are European style, which means that they cannot be exercised until expiration. Equity options, by and large, are American style options that can be exercised at any time up to expiration. American style short options can be assigned then at any time up till expiration, regardless of where they are in the money, at the money, out of the money. Index options that are European style cannot be assigned early. One of the reasons potentially for traders to choose index options over others, but we'll talk about that as we get into the discussion. Now, one thing to think about as we talk about some of these strategies, we will be discussing strategies that get into that realm of time close to or very near to expiration. So it's important to remember that when trading options at or near expiration, you've got to consider the risks specific to the strategy, including the lack of liquidity, significant price change and slippage, and volatility and option Greeks that may cause a situation where profits disappear quickly and can potentially turn into losses at that closing time frame as we get close to expiration. So be aware of that. We'll talk about that as we get into some of those particular examples here. Also remember, the probability analysis results theoretical in nature, not guaranteed. Neither is technical analysis, neither is fundamental analysis. And Schwab doesn't recommend the use of technical analysis as a sole means of investment research. We're going to be using the thinkorswim desktop software platform today, specifically the paperMoney version of that platform. Not a guarantee of future success out there in the real world, but a great sandbox and learning environment. But it does not, the paperMoney version does not do some of the things that a live trading account will do. So just be aware of that as you move your practice from paper trading to live trading. Now, let's pop over here to the thinkorswim desktop software platform. Quick reminder as we do this, click on subscribe down there at the bottom of the page if you've not done so already. Great way to follow us, great way to stay connected to the community, and it helps to bring the content up to the top of your feed as well as others' feeds, and it's at no cost to you. So click on that subscribe button there. Also, while you're at it, Cameron has posted this at the top of the chat. Follow us on X at Ben Watson CS, at Cameron May CS. The other coaches are in a similar naming convention. We post a lot of great stuff over there, including short videos over on our X feed. So join us over there for that information as well. So the reason I'm starting today on Nvidia and not on the indexes is because I wanted to make mention of a couple things. I talked this morning, I was hosting Trader Talks in today's market with Brent Moores this morning. We talked a little bit about the relative weighting of this particular individual stock in some of the indexes. It's about 7% of the weighting in the S&P 500 or the SPX index. It's about 14% of the weighting component in the NASDAQ, the NDX. And so as goes Nvidia, so may go the indexes, at least in the short term. Now, that doesn't mean that they always trend the same. They have their own forces at work. And it is just one component, but it's a pretty big heavyweight component of those indexes. So it's important to pay attention to what might influence the movement of those particular indexes. So given the fact that we are on the cusp of earnings for this particular heavyweight component of those two indexes, it's important that we recognize the fact that if this particular stock moves on that earnings announcement, that can have potentially an impact, and potentially a serious impact or significant impact on the indexes at hand, namely, in this particular case, the SPX and the NASDAQ, of which it is a large component. So earnings announcement comes after the market close today. That's going to be a concern, perhaps, to a portfolio that has significant exposure, say, for instance, to information technology, that has significant exposure to the NASDAQ index. If the market were to move, or if this stock were to move on that earnings announcement and the market then were to move in response to that, that could impact a portfolio. So we'll talk about that. But I just wanted to kind of bring this up as the starting point of this particular discussion. Now let's pop over here really quickly to our index grid and see what's going on with the indexes. And you can see, to a certain degree, this is the SPX, and the SPX consists about 7% of Nvidia. So about a 7% weighting or component in this particular index. And as we start to look at this movement, slightly up today. It was down just a little bit early on when Brent and I started talking about it this morning at market open. This index was down just a little bit, like 0.01%. Now it's up 0.17%. So starting to see maybe that move back in an upward direction. But the other thing I wanted to point out in this particular case is the fact that we look at Friday, and Friday was a pretty significant move. It was one of the larger green candles that we've seen really in the last little while. Now, we've had a big red candle back here, but we go back in time, and you got to go back, say, for instance, to the 27th of May to get to the last real big green candle that we saw in this particular index. I just want to look at something really quick, just out of curiosity. I'm going to change my chart really fast. NVDA. And I want to look at the last earnings date. Okay, yeah, so 5/27, 5/28 was the last earnings date for Nvidia. If we go back to the SPX, we see that the last big green candle that we saw on the SPX, let's just kind of zoom back. There's that last really kind of biggest green candle. And that big green candle came just ahead, 2 days ahead of Nvidia earnings. Well, here we are in kind of the same scenario, right? Big green candle on Friday, coincidental to the Nvidia earnings, not because of, post hoc ergo propter hoc, after this, therefore because of this. That's kind of the scenario that we get into. It doesn't mean that there's causality here. This was largely driven by Chairman Jay Powell's commentary on Friday in the Jackson Hole Symposium about the potential for interest rate cuts. And so we see this big move to the upside in that big green candle. And, you know, that expectation also brought an increase, if we were to pop in here, implied volatility. IMP, implied volatility, into this mix. Let's click on apply and OK. We saw that that green candle to the upside came as a function of, and then brought after it, a little bit of an increase in implied volatility. But volatility is very low relative to where it has been, and especially relative to where that April low has been on this particular index. So not a lot of volatility in here. Not big moves in terms of that volatility, but a little bit of an increase and then a bleed off of that volatility. At the same time, that illustrates and demonstrates the fact that markets can and do move. And we've got to be respectful of that we get kind of locked into a mindset. We get kind of locked into this trend. We can see that markets can move in both directions, both to the downside and to the upside. And that can disrupt strategies that we might put on. So I wanted to be aware of that. Now let's take a look at the NASDAQ. And we can see that Friday, the NASDAQ saw the same kind of thing. Now, Nvidia represents about 14% of the weighting in the NASDAQ 100. Smaller pond, bigger fish, bigger influence on the pond, if you will. If you've been following my discussions of liquidity, we talk about fish and ponds. So we see that upward movement, but a little bit lower performance relative to the previous all-time high. Today, only up about 0.06% on the NASDAQ 100, maybe a little bit more of a wait-and-see mode ahead of this earnings announcement. And we take a look at the Russell 2000. The Russell 2000 kind of blasting higher here off of a little bit of a bull flag. And again, that may be a function of, you see the bigger response to the Jackson Hole speech by Jay Powell on Friday that came as a function of the Russell 2000 being made up of small caps. And small caps arguably more sensitive to changes in short-term interest rates because of lending needs and financing needs and so forth. Also considering the fact that about 20% of the makeup of the Russell 2000 is regional banks, small cap financials that have a greater sensitivity to changes in those short-term rates. So that has a bigger impact here. And we see a little bit stronger performance, up almost a little more than 0.5% today in the Russell 2000 index. So, and some movement higher here in terms of the RSI. So a little bit of momentum going on in this particular index. So we'll come back to this. We'll circle back to this. Now, what I want to do is I want to come over to our monitor. Before I did that, I wanted to go to our VIX grid here, and we'll take a look at the VIX just to kind of see what that implied volatility is doing. So market's up, volatility is up. Volatility is up just a little bit. It's up 1.64% today. And in relative terms, that's a pretty large move, but relative to how the VIX normally moves and normally crushes to the downside, this isn't a big spike in volatility, but this is a situation where we have VIX up and we have market up. And usually that doesn't work that way. That's an unusual situation. And a lot of that has to do with speculation. So think about this, and this will kind of bring this discussion full circle in this conversation. So this particular index, the VIX index, is a function of implied volatility, meaning supply and demand for SPX options. And normally it's driven by put options getting more expensive when institutions feel that there is downside risk, or there's already been a downside occurrence and they want to hedge against that further downside risk. They buy put options. But think about what's also potentially going on here when you have a situation where the market is up and the VIX is up. That's not protection against downside risk necessarily. That may be speculation about upside potential. And we oftentimes talk about the idea of the market doesn't hedge against crashes to the upside, but they certainly do speculate on upward movement. So this may very well be driven, this particular circumstance where the VIX is up and the market is up, may be driven by speculation that a big component, i.e. Nvidia, may make a big move to the upside on an earnings announcement. And one way to take advantage potentially of that is to go long call options on the index that may be affected by the individual stock. The other side of that coin is, what if there are lots of short positions on the market and institutions wanted to cover those short positions or hedge against those short positions moving back in an upward direction? They might also buy calls to hedge against those short positions. So whatever reason, there's very likely some buying pressure going on in terms of that response to an earnings announcement as a major component. Now, talking about, I mean, this isn't manipulation, this isn't nefarious, this is simply market reaction to the potential of what's going on. So Waisu asks a question: is the VIX poised to rally back up given its current location on the chart, meaning the VIX is generally low? And does that also mean that S&P 500 or the NASDAQ is going to fall? Not necessarily. Because think about this. This is a summertime pattern for the VIX, right? This is a summertime scenario. We go back in time. If we go back out, say, for instance, to a 2-year, let's change our time frame here, to a 2-year VIX perspective, and you can see that summertime, barring yen carry trade unwind, volatility, and things like that going into an election cycle, summertime VIX tends to be, as you can see, the beginning of last summer, summertime VIX tends to be fairly sedate. But news can happen, right? News can come out of anywhere. Nobody expected the yen carry trade unwind, which was the cause of this big spike right here. So, cautionary tale, even in a slow VIX, we take a look at this in that 1-year daily chart, even with a slow VIX, with the VIX grinding down around that 15-14 handle, that VIX could rally pretty significantly to the upside. And it could, but that's going to be an emergent situation, perhaps, not necessarily an overall upward grind. So that's where we are at the moment with volatility. I wanted to bring that into the mix. Now let's go over to the monitor tab. Yeah, Cameron, you're right. Summertime VIX sounds like a top 40 hit. Maybe, who knows? Hey, Taylor Swift, you want to make a summertime VIX song? I don't know, perhaps. All right, let's take a look at our index options examples here. So we have a long call option on the Russell 2000. So going into that particular perspective, it has 34 days to go until expiration. It's the 229 strike, or excuse me, the 2290 strike call. And the market's currently sitting at 23.71. So this is in the money. It's getting deeper in the money, but we're getting to the point where time decay may start to grind away at that. Bought it for 82.10. It's currently trading at 114. So we're going to examine rolling that as a possibility to keep that trend going. So that's one. We'll come back to that. The other one that I wanted to look at is this one that we normally do. This is the 14.7. Now, I was on vacation last week. Now, Connie may have accomplished this, but I did not. I looked at it, but I did not do anything with this particular trade. Because normally what we do is we put this trade on, we sell a call spread or we sell a put spread, depending on the trending direction of the market, at 14 days to go until expiration. And then we take it off at 7 days to go until expiration, come what may. I did not do that. I'm fully admitting that I did not do that because I was out of town. And on purpose, I kind of closed things down. Now, I looked a little bit, but I didn't do much. Now, notice right now, we sold it for $1.70. It's currently trading for zero bid. So we could let this expire worthless at this particular point, but there is still risk here, right? Because this is going to expire today. And what's potentially out there that could move the market today? Nvidia earnings? Yes. So we in terms of the cautionary tale, we want to manage this positively. Now, active trader says, can I repeat that? We buy it at we sell it at 14 and we buy it back at 7, come what may. Sell it at 14, buy it back at 7, come what may. Okay? So, yeah, get out at 7 days. Exactly that. So I didn't do that. It's now trading at 0. So we're going to close this one down. Now I'm going to right click and create a closing order. Several people have asked the question, how do you close a vertical spread? And how do you close an index vertical spread? It's the same way that you would close a vertical spread on an equity option. And that is, you come over here to the monitor tab, right click, create a closing order, and we're going to buy it back because we sold the spread to begin with. Now it's currently, notice this, it is currently trading at a 0 bid. What we need to do is give that a little bit. So I want to be able to get out of this positively. I want this to close down. Now, at the very least, I want to close down the short one. Not because we have assignment risk, which we don't. This would be a 0 DTE option in this particular case, since it is now at 0 DTE, 0 days to go until expiration. But we're going to close this down positively, or at least close down the short leg so that we don't have that obligation risk post expiration. But remember, assignment risk in an index option that is cash settled isn't going to result in a short, is not going to result in a short stock or a long stock position. It's going to result in a debit or a credit of cash. So we've got to be aware of that in terms of that scenario. So I'm willing to give this a little bit. I'm willing to pay up to 5 cents to close this trade down. So I've moved my slider up here to the natural, which is where it's currently sitting. And so if I click on confirm and send, and we read through this, make sure that this is what we're willing to do. Remember, I want to make sure that this is saying to close. I want to close this position, and I'm willing to pay $5 to close this down positively and be done with it. That's what we're looking at doing in this particular case. And again, cautionary tale. Remember, markets can still move into the close even before that option expires. And guess what? After expiration as well. So paying attention to this. We're going to read through this, make sure that there are no alerts that we need to pay attention to. We're going to go ahead and click on send and fire that order off. And we're going to see. Now, we may not. This is, again, I want to illustrate this as a cautionary tale. This is one of the potential dangers of holding, in this case, a far out of the money option or option spread into that 0 DTE. There may not be liquidity to get out of the trade. There may not be liquidity to get out of the trade. Let's open this chain up, and we're going to have to go out to about 100 strikes to get to the chain. Here it is. There's not a lot of liquidity here on the bid side, okay? So Rita asks the question, why does it affect us if it moved after expiration? Now, here's a difference. This option, these options, this particular expiration settles on the print at the close. However, there is still a window post expiration where an option buyer could choose to exercise. And remember, the only time that an European style option can be exercised is at expiration. So if the market were to move in that time frame immediately following an earnings or following the expiration, that might be an inducement to an option buyer of an index option to exercise their option. So we want to close this down prior to expiration, prior to the time running out today, positively, to avoid that. Now, we're far enough out of the money here that it's not likely to be a scenario. If we were close to the at-the-money position, then that would be a much bigger deal, Rita, for sure. Now, there's one other scenario that I want to pay attention to, and I want to talk about this. Now, we don't have it here until we get out a little bit further. But if we were to close down a position, and I have a trade on this one as an example, because as we get closer to this one, I want to illustrate this for you. So in a couple of weeks, in 22 days, I want to look at this one because we're going to be talking about it. This is an AM settled index option. So the reason that this is a different scenario, one of these things is not like the other. All of these others settle on that afternoon print, on that closing print. This one that has that AM designation stops trading at closing time on the 19th of September, but it settles on the next print the next morning, that AM settlement. That's that reflection. So that settlement comes as a function of what happens to the market between closing time of the cash market and the next print. So if the market moves and there's a gap, those options are now subject to that next morning's print and not the closing print. That's the difference between an AM settled and a PM settled option. And you see that in, say, for instance, if we were to look at VIX options, we've traded a lot of VIX options in this particular class as examples. You see that those VIX options are all AM settled index options. So SPX, we go back to that. I want to demonstrate this, and we'll talk a little bit more about it as we get to the expiration of this one, but I put a trade on so that we can see how that works so that in the future I can demonstrate it. So I'm always thinking about you guys looking forward. All right. So we're going to keep, Rick says, what is the purpose of an AM settled option? It's primarily an institutional position. It allows institutions to react to and adjust to overnight moves. And it also allows market makers to hedge their risks in terms of settling those options. So if the market moves in that time frame, they have the ability to buy or sell or open or close positions to adjust their balance of risk. So that's one of the reasons why you see it oftentimes on the VIX, those VIX options. But it's a matter of convenience, and it's a matter of institutions primarily hedging. As retail index options traders, generally, traders may want to stay just from a matter of that potential and understanding of what the settlement price is. Those retail traders that trade index options may want to stick to those that have that PM settlement. So good question to ask, Rick. So we're going to try to work our way out of that one in this particular case. And we may work that order a little bit and give it a little bit. Now, since we are in paper money, this is likely to fill at the midpoint. So what we might even do is come back to that monitor tab, and we might have to bump this a little bit. We're giving it 5 cents. I'm going to right click and we're going to cancel replace this order to close it. I'm actually going to give it even a little bit more. I'm going to give it 10 cents because I want to close this positively. All right, close it positively. So we're going to click on confirm and send, read through the order, make sure that we're aware of that. I'm going to put it back in my index options weekly, click on send, and we're going to fire that order off. We'll see if we can work our way out of this. Paper money is going to be a little bit different, obviously, than a live trading account, where a live trading account, that's going to go out to the market. It's going to be seen by market makers, and they are likely to either fill it or not based on what their risk is. But that's one of the risks of a zero DTE option, is that when you try to close it, it might not be there. That liquidity might not be there to close. And that was one of the disclaimers that I gave you at the beginning. All right. We've talked through this a lot. Okay, cool. So let's do this. Let's go to our chart. Let's go to our index grid. Boy, I wish we had double the amount of time that we normally have today, because there's a lot to talk about. So here's where we were before. I'm going to right click and I'm going to remove that hack, that time hack. So what I've got on the left-hand side is the 1-year daily chart. What I've got on the right-hand side is the 3-month, 1-day chart. For those of you who are brand new to this webcast, I'm glad to have you here. I'm going to just make this a little bit bigger. The cone that I have on here is the 1 standard deviation probability of expiring cone. So that tells me where that 1 standard deviation area is, up or down from the current price of the stock. So I'm going to go back to my trade tab for the SPX, and I'm going to look at where our expiration is. That's 14 days to go until expiration, and that is the 10th of September. So I'm going to come back to the chart, and we're going to find the 10th of September right here on that chart. By the way, on the 10th of September, we will be in Washington, D.C. Actually, the 11th and 12th, or 12th and 13th of December, we're going to, or not December, September, we're going to be in Washington, D.C. And that is our workshop in Washington, D.C., our technical analysis and option strategies workshop. I'm going to be there. Kevin Horner is going to be there. Ray and Scott are going to be there. What I'm going to do is I'm going to put a time hack here. Let's change our tool to that time hack. It's just a time level instead of a price level. And so we're going to go to September 10th, and I'm going to put that in there right there. And then I'm going to grab my trend line tool, and I'm going to just do a crossover right there. I'm going to put a price level at 62.92, and I'm going to back that off to 62.90. And we'll just put that cross right there so that we can keep that. You can see where each of our other trades have been as they've been moving. This is falling right about the same level in terms of price. Okay. So we are going to do a fresh 7 to 14. So this is a new fresh 14.7 as we keep moving on this. So the other thing to think about is if we go back to our chart, somebody asked me the question, well, why are we taking this directional movement in a bullish direction if it's so high up here? Well, yeah, it's still trending in a bullish direction. There's no guarantee that this index is going to move down. And in fact, the 200 period moving average, which we're kind of using as our definition directionally, is still moving higher, and the index is still above the 200 period moving average. So yes, we could sell a call spread above, but in this case, we're taking that trend direction. We're taking that trend direction, okay? So here's where we're going. We're going to the 62.90 strike, and we're going to sell the 62.90 strike put option. We're going to create a short put vertical spread. We're going to go to the trade tab. We're going to go out to the expiration that's the 10th September. Now we've got 100 strikes in here, and we're going to go to the 60, what did we say? 62.90, not 63.90, 62.90, which is right here, which if I change this layout to Delta Theta Vega, that 62.90 strike is about the 15 cent delta, which is about where we've been falling on this strike. 10 cent wide bid-ask spread, 20 cent wide now, 30 cent wide. It's bouncing back and forth here. There's still liquidity here at this strike. Still a fairly tight bid-ask spread. So we are going to sell the 62.90, and we're going to bring in about $13.80. And then we are going to sell or buy, excuse me, the 62.90. We're gonna then buy the 62.70, which makes it a 20 wide vertical spread. Now we could make it wider. Yes, it's going to increase our theoretical maximum loss, but it's going to cost us less. So we've been keeping these at $20 wide. 90 to 70 is $20. So we're going to go right there. And for this 20 wide vertical spread, short put vertical spread, we're getting about $1.65 thereabouts. It's bouncing back and forth between $1.60 and $1.70. Now, if we click on confirm and send, we're getting $1.60, and our loss is $18.40. In other words, $160 against the theoretical maximum loss of $18.40. But that's a low probability of taking that max theoretical loss. Could we still do it? Yes. Could we still do it? Yeah, we could still take that max loss, and we have done that a couple of times. But this is a highly probable trade. Selling it at 14 days, buying it back at 7 days. The idea behind this is that we do this on small gains, week after week after week after week after week. That's the reason why we might do that. So now we're going to go ahead and we're going to click on, actually read through this order, make sure that we're aware of that, to open, make sure that there are no alerts that we're going to do that. Now, when I say we're getting small gains week after week, that's the intent. That is never the guarantee. And we know, like I said, we have taken couple of 2 or 3 max theoretical losses on this trade. And remember, this is come what may. So that's kind of the scenario here. So now we go back to our chart, and that's where our trade is. Now, I want to show you this because somebody asked me the question. I'm going to come back to maximize this sell. I'm going to go to the gear icon, and I'm going to do 2 things. One, I'm going to show trades on here. Click on apply and OK. And it did, because let's see, did it do it? No, it didn't do it. Why is it not showing my trades? Let's do that. Because we're on general, it should show me my trades. But if I wanted to show those expirations, because somebody asked me the question, showing expirations, we can show some of those things. We can show the expiration lines. If we come over here and we show, say, for instance, option expirations, I think that'll apply here too. It will. Okay. So that's where we will see those option expiration dates. So you can see those expirations right there. Come back to that gear icon. I want to take that off because I don't want to show, let's go to equities. I don't want to show those options. That's showing the options. Wow, we're almost out of time. Holy cow. All right, so there's our trade. And let's go back to our monitor tab. Let's look at where we are. So here's our new one right here. We still haven't worked our way out of this one, but we brought in $1.60 and it started to gain a little bit of value. But we're going to look at closing this down at 14 days or at 7 days to go. Oh, there we go. Thanks, Myron. I appreciate that. All right, so we're going to close this one down next Wednesday, 7 days to go until expiration, come what may. So that's how we're going to manage that trade. Now, the last thing I want to do here in this particular discussion is I want to go to this group right here, which is our stocks group. And in this stocks group, I've got a number of positions in here. I've got financials, I've got some utilities, but look, I've also got communication services, I've got information technology, I've got some energy and materials and so forth, but I've got this sorted according to sector. And I've got a fair component and a fair exposure in this particular portfolio to technology. Now, remember, we said that the NASDAQ consists of about 14% Nvidia. So I don't have an Nvidia position in here. But if I wanted to prevent or to offset any potential downside movement or some potential downside movement in this portfolio, in this group of stocks, because the NASDAQ moves down and because this portfolio is relatively sensitive to the NASDAQ, I can beta weight this portfolio to the NDX, meaning I'm converting all of these sensitivities into NDX sensitivities, which means that this portfolio is sensitive to the tune of about, now I'm going to take this one out really quick, this NDX position. I'm going to move this to my vertical spreads group for just a second. So this portfolio is sensitive to the NASDAQ to the tune of about 34 deltas. So if the NASDAQ moves up $1, this portfolio should gain about $34. Likewise, if the NASDAQ moves down $1, this portfolio should lose about $34. So ahead of this Nvidia earnings, which could drive the NASDAQ to move, I want to offset a little bit of that directional potential. Now, because we're hedging this with the index, I'm not detuning my specific individual Nvidia position. So if I had a long position in Nvidia, rather than, say, for instance, selling that Nvidia position ahead of the earnings announcement or buying a put specifically on Nvidia, I'm just detuning my overall portfolio by using an NDX position. So what I'm going to put in here is what we started 2 weeks ago in my vertical spreads. That's this NDX position. So I'm going to move this back to our group stocks. And this particular NDX position that we have here is a short call vertical spread on the NDX. Now, a short call vertical spread has negative deltas. So what I've done is I've removed about 11 deltas, in other words, about $11 of sensitivity out of this portfolio to that move to the downside. Okay. All right. So in this particular case, I've removed some of that sensitivity to the NASDAQ moving down, but I've also removed some of the sensitivity to the NASDAQ moving up. So we've got 34 days to go on this vertical spread. We sold it originally for $140. It's now trading at $60. This was an expensive, well, this could be potentially an expensive hedge, but this is doing what we wanted it to do, right? This is doing what we wanted it to do, which is decrease in value. We sold it, we brought in some premium, and we brought in some negative deltas, more importantly. So given that fact that this NDX spread is moving in the direction that we want it to go, I'm going to leave that on here as a hedge, at least through the Nvidia earnings announcement, to protect potentially against that downside movement. So it's been working in our favor. That is one way to hedge. But remember, hedges are not intended to be on all the time. They're intended to be put on when there is a circumstance that warrants having a hedge on. And they're not intended to be profitable. They're intended to be protection. Sometimes they can be profitable, but overall, putting on a hedge like this in this short call vertical spread on the NDX, on the NASDAQ index, is intended to be a protective position, not a profitable position. So, but it is in fact, in this particular case, working in our favor. It's bringing in a little bit of premium. So that's the intent of this particular discussion. All right. So John, I want to go back to John's question. Where do you get the green and red stats on my chart? So we go back up to the chart, and let me pop back to this one. I think this is what you're talking about. Let's restore the cells. Is that, so these numbers right up here at the top of this particular chart, that is a study. And I'm going to go to the maximize the cell, and we'll take a look at this. That is a study called New Percent Change, and it's a study, a ThinkScript study. So I'm going to do this really quickly here at the end. I'm going to share that with everybody. Remember that shared items are not guaranteed as to time or accuracy. I'm going to hit Control V, and I'm going to post it out here in the chat for you to grab. You can apply that once you import it into your thinkorswim platform. You can apply that as a study on your chart. And there it is right up there at the top, and you've got that information. So there you go. I gave that to you. I will also link that in the description for those of you that are watching this after the fact. So Rick asks the question, how does that NDX trade hedge if it's a bullish trade? So let's go back to that real quick. Let's just review this. This is a short call spread. Short call spread is a bearish biased trade. So it is bearishly biased, benefits if the NDX goes down, or if time passes, or if implied volatility falls. If we were doing this as a short put spread, like we did on the SPX, then that would be a bullishly biased trade. But in this particular case, we put on this NDX trade, short call vertical spread, as a bearishly biased hedge against the NDX going down, which is where the majority of the sensitivity comes in this stock position. So that's the reason for that particular trade. Guys, lots of great stuff here today. There is a lot going on. We've got more to talk about. Follow me over on X at Ben Watson CS. Follow Cameron on X at Cameron May CS. And if you want to learn more about index options, pop over here to the webcast page, youtube.com/@Trader Talks Webcast. Click on subscribe if you haven't done so already, and follow us over there. Great stuff out here. If you want to learn about index options, just type in the word index, and now you've got Lots of information about those index options, intro to index options. Cameron talks about it, about index options. So lots of stuff going on with index options here in the webcast page. Great stuff to have there. Thank you guys for a vibrant conversation today. Thanks to our great producers and our great reviewers, Gene and Nikki. Appreciate you doing that. And thanks, of course, to Cameron May. We'll see you guys again very soon. Take care, everybody. Have a great day. Take care. Bye-bye.